This is a pension statement, a piece of paper that arrives once a year telling a 58-year-old teacher in Frankfurt that she has 847,000 euros saved for retirement, that when she turns 65, she'll receive 4,200 euros per month until she dies. Guaranteed. Backed by the full faith and credit of one of the most sophisticated financial systems ever constructed. Except, here's what that piece of paper doesn't tell her. The fund holding her money doesn't actually have 847,000 euros set aside with her name on it. What it has is a claim, a promise, an accounting entry that assumes a 7% annual return, a stable bond market, and a ratio of workers to retirees that stopped existing 15 years ago. Her money isn't sitting in a vault, it's sitting in a spreadsheet. And that spreadsheet just collided with a reality that pension actuaries have been quietly panicking about since October 2025. On January 17, 2026, at 6:15 a.m. Central European Time, the European Insurance and Occupational Pensions Authority published a document that no major news outlet covered. 47 pages of technical assessment that, buried on page 31, contained a single paragraph that changes everything. The aggregate funding ratio of European defined benefit pension schemes has fallen below 68%. Not 90%, not 80%, 68%. That means for every euro European pensions have promised to pay retirees, they currently hold 68 cents. The gap, the 16 trillion euros gap, is not a future problem. It's not a 2040 problem. It's a problem that exists right now, today, on balance sheets across the continent. This is not about pensions being underfunded. This is about the mathematical impossibility of promises made to an entire generation. Here's what they're not telling you. The pension system that built post-war Europe was designed for a world that no longer exists. In 1960, when Germany established its modern pension framework, there were 6 workers paying into the system for every retiree drawing out. 6 to 1. The math was elegant. Young workers contributed a fraction of their wages. Those contributions paid current retirees. And when those workers themselves retired, the next generation would do the same. It was a chain letter that worked as long as the population kept growing. Today, that ratio in Germany is 2.1 to 1. In Italy, it's 1.7. In Spain, 1.9. The chain letter has run out of new participants. But the promises made to the early participants, the ones who paid in for 40 years expecting to collect for 20, those promises are still on the books, still legally binding, still showing up on pension statements as guaranteed income. The European Central Bank understood this problem a decade ago. Their solution was elegant in its simplicity: financial engineering. If pension funds couldn't generate returns from a shrinking workforce, they would generate returns from asset appreciation, bonds, equities, real estate, alternative investments. Push pension assets into markets, let those markets rise, and the funding gap closes itself. For 15 years, this worked. Interest rates fell from 4% to 0 to negative. Bond prices rose mechanically as rates declined. Equity markets quintupled. Real estate doubled, then doubled again. Pension funding ratios climbed from 72% in 2010 to 94% in 2021. The crisis was solved. The spreadsheets balanced. The actuaries stopped sending warning memos. Then rates rose. And everything built on the assumption that rates would stay low forever began to crack. This is where the lie becomes unsustainable. To understand what happened on January 17th, you need to understand the most dangerous trade in European finance. It's called the liability-driven investment strategy, LDI. And it's not a hedge fund gimmick or a speculative bet. It's how nearly 8 trillion euros in European pension assets are managed right now. The theory behind LDI is seductive. Pension funds have long-dated liabilities, promises to pay retirees for decades into the future. Those liabilities behave like bonds. When interest rates fall, the present value of future pension payments rises. When rates rise, the present value falls. This creates volatility on pension balance sheets that makes funding ratios swing wildly based on rate movements. LDI was designed to solve this. By loading pension portfolios with long-dated bonds and interest rate derivatives, fund managers could match their assets to their liabilities. Rates fall, liabilities rise, but so do bond prices. Rates rise, liabilities fall, and so do bond prices. Perfect hedge, stable funding ratios, happy regulators. The problem is leverage. To generate enough return to actually meet pension obligations, not just hedge them, funds had to amplify their bond exposure using derivatives, swaps, repos, gilts borrowed against future gilts. At the peak, some UK pension funds had effective leverage ratios exceeding 7 to 1. For every pound of actual assets, £7 of bond exposure. We saw what happens when this unwinds in September 2022. The UK gilt market collapsed in 4 days. Pension funds faced margin calls they couldn't meet. The Bank of England intervened with £65 billion in emergency purchases to prevent a cascade of forced selling that would have rendered dozens of pension schemes insolvent overnight. That was a warning shot. Europe didn't listen. When institutions do what we saw last week, they're not managing risk, they're containing disaster. The January 17th report wasn't just an assessment, it was an autopsy of what happened between October 2025 and January 2026. 3 months that unwound a decade of financial engineering. It started quietly. On October 3rd, the European Central Bank announced it would accelerate the runoff of its bond portfolio, quantitative tightening. The ECB had been buying European sovereign debt for years, suppressing yields, keeping funding costs low for governments and pension funds alike. Now they were stepping back, letting bonds mature without replacement, allowing the market to find its natural clearing price. Within 6 weeks, German 10-year Bund yields rose from 2.4% to 3.7%. French OATs went from 2.9% to 4.2%. Italian BTPs crossed 5.5%. For a normal investor, these are moderate moves. For a pension fund leveraged 5-to-1 in long-dated bonds, these are extinction-level events. The margin calls began in late November. Unlike 2022, when the crisis was concentrated in UK gilts, this time it was continental. Dutch pension giant ABP faced a €12 billion collateral call in a single week. Denmark's ATP required emergency liquidity from the central bank. French pension funds began selling equities to meet bond margin requirements, triggering a 14% decline in the CAC 40 between November 15th and December 20th. The ECB intervened on December 23rd, a €40 billion emergency lending facility specifically for pension funds. No press conference, no Lagarde statement. A technical notice published at 4 a.m. Frankfurt time on a day when half of Europe was already on holiday. They're buying time, the same way the Bank of England bought time in 2022, except the hole is bigger now, and the tools are smaller. Less than 90 days remain before the first wave of quarterly pension payments comes due in April. If funding ratios don't stabilize, pension trustees across Europe face an impossible choice: reduce benefits, demand emergency contributions from sponsors, or admit insolvency. While one side prints, the other side hoards. This is the generational asymmetry that makes the European pension crisis different from anything we've seen before. The system was built by a generation that had 6 workers supporting each retiree. It will collapse on a generation that has 2. And the generation caught in the middle, the 55 to 70 cohort that paid in the most and expected to collect the most, has no time to adjust. Consider the mathematics of a German auto worker born in 1965. He entered the workforce in 1985. For 40 years, he's paid into a pension system at rates that assumed 6-to-1 support ratios. He's been promised a retirement income that reflects those contributions. He turns 60 this year. Under current rules, he can begin drawing reduced benefits at 63 and full benefits at 67. But the system that made those promises now has 2.1 workers per retiree. His contributions didn't accumulate in a vault. They paid the pensions of the generation before him. His pension will be paid by the generation after him, a generation that's smaller, more indebted, and facing its own housing and cost of living crisis. This is not a funding gap. It's a demographic impossibility dressed up in accounting language. The solutions being discussed in Brussels reveal the depth of the problem. Raise the retirement age to 70. Reduce benefit formulas by 15 to 20%. Increase contribution rates for current workers. Each solution is politically radioactive. Each solution transfers the cost of promises made decades ago onto people who had no vote in making them. Meanwhile, those who understand the mathematics are acting accordingly. Physical gold purchases by European retail investors increased 340% in 2025. Property transfers to family members, a traditional European wealth preservation strategy, reached record levels in Germany and France. Capital flows out of European pension wrappers into self-directed accounts have accelerated every month since October. The informed aren't waiting for April. They're not waiting to see if the ECB's €40 billion is enough. They're recognizing that a system built on 6-to-1 cannot survive at 2-to-1, regardless of how creative the financial engineering becomes. This is what a system looks like when it runs out of people. Every response available to European policymakers now accelerates the collapse rather than preventing it. Raise retirement ages, and you delay the problem by 5 years, while destroying political support for reform. Cut benefits, and you trigger the social unrest that makes further reform impossible. Increase contributions, and you drive more young workers to emigrate, worsening the demographic ratio that caused the crisis. Print money to fill the gap, and you inflate away the purchasing power of the benefits you're trying to protect. Picture a bathtub with the drain open and the faucet running. For decades, more water flowed in than out. The tub filled. Everyone admired how full the tub was becoming. They made plans based on the tub staying full forever. They wrote contracts guaranteeing access to the water. Now the faucet is slowing. The drain is widening. The water level is falling. And 50 million Europeans are holding contracts that promise them water from a tub that will be empty before they die. The pension statements will keep arriving. The numbers will still look reassuring. 847,000 euros in accumulated benefits. 4,200 euros per month guaranteed. But a guarantee is only as good as the system standing behind it. And the system standing behind European pensions is now running a 32% deficit, with demographic trends that make recovery mathematically impossible. The question is not whether benefits will be cut. The mathematics guarantee cuts. The question is whether those cuts are orderly, negotiated over years with advance warning, or chaotic, imposed in a crisis when there are no other options. January 17th's report suggests we're closer to chaos than order. A 68% funding ratio isn't a yellow warning light, it's a red one. The 40 billion euro ECB intervention isn't a solution, it's a tourniquet on an arterial wound. Some will look at their pension statements and feel secure. The numbers look solid. The institutions sound permanent. The government will never let pensions fail. It would be political suicide. These are the same voices that said European sovereign debt was risk-free in 2010, that said negative interest rates were temporary in 2015, that said inflation would never return to Europe in 2020. The voices are always confident. The mathematics are always indifferent. Others will recognize what the January 17th report actually represents. Not a technical assessment, a confession, an admission that promises made over 50 years cannot be kept with the demographics of today, that the gap between what was promised and what exists is not 16 trillion euros on paper, but 16 trillion euros in human retirements, human dignity, human expectations that will not be met. The informed are not panicking. Panic implies surprise. The demographic data has been public for 30 years. The funding ratios have been declining for a decade. The LDI leverage has been building since 2015. January 17th didn't create a crisis. It documented one that anyone paying attention could see forming. What the informed are doing is simple. They're reducing dependency on promises. They're converting paper claims into tangible assets. They're diversifying across jurisdictions, across currencies, across asset classes that don't require a 6-to-1 support ratio to function. They're not betting against the system. They're acknowledging that the system was built for a world that ended 20 years ago. This is not financial advice. This is not a recommendation to abandon your pension or distrust your government. This is simply an observation that mathematics doesn't negotiate, that demographics are destiny, that a promise made in 1990 about the world of 2030 was always a guess, and that guess is now colliding with a reality that refuses to cooperate. The European pension system promised security to a generation that built the modern continent. Reality is reminding us that promises require resources, and resources require people, and people are the one thing Europe stopped producing decades ago. The divergence between what was promised and what can be delivered is not a policy failure. It's arithmetic asserting itself after a 50-year delay. And arithmetic, unlike politicians, cannot be voted out of office.